Jake, fantastic to have you back on ET Now. Thank you for joining us.
Thank you.
It's turning out to be like a dream year, isn't it?
Well, I'm not sure about the thing. It's a dream because I think we're still part of it. So,
no, I didn't say the dream is over.
So it's only a dream if you wake up to find that what has happened, kind of thing. I still think we're in the middle of a lovely reverie, as it were. So the way I see it is, I think the greatest consensus in the market right now is that this market has liquidity support but no valuation support. Exactly. This is the greatest consensus. And to my mind, at all points in time, we've got to figure out or try and work out which is the best consensus or which is the common theme that's running across, and that theme never kind of plays out. So if this is the consensus that valuation support is not there but only liquidity support is there, liquidity support is a fact of life. I suspect the valuation support is coming, the market is sensing it, and the market is sensing valuation catch up. So I think the next quarter results, even these quarter results have not been bad to the extent whatever we've seen so far, have not been bad results. So if this quarter has not been too bad and the next quarter is going, to my mind, going to be a big significant pickup from this, I think the markets will look back and say, it was always valuations, you saw liquidity and you thought that was a consensus, which is why a lot of people are on the sidelines with money. People are cautious and, as they say, logically cautious. And people have worked out that there's going to be a sharp correction. So to my mind, this market's not about to sort of, roll over and play dead.
Jakes, if I look at India, we feel very happy about our positioning. We are one of the fastest economy in the world, great demographic, strong political reforms. We are different. But the grain of the truth here is that Indian markets in last 1 year have exactly mapped the Dow. How much of the current price action is just a function of global markets? And when global tide will reverse, we'll also be caught with our pants down.
I think the big difference is it may have mapped in terms of being a global bull market and we having done very similarly, in fact, underperformed some markets. But I think the difference is in this market, foreigners have been selling, net sellers, and locals have picked up the baton and moved on. And I think that's the big difference, that at some point in time, my thesis is that foreigners will have to return to the extent they have. And you could look back and say a lot of the, should I say, the arbitrage positions, which is where foreign selling has been happening and local arbitrage funds have picked up, has been, for instance, P-notes has been at their lowest level for 7-8 years.
You can't go short in P-notes now.
So which means that foreign arbitrage funds have given way to local arbitrage funds, and that could explain a lot of the selling there, while long only players in the overseas markets have remained passive. They have not pumped in fresh money except for IPOs. So you could, to my mind, that's what's happened, that long only players of fresh money has come into IPOs, maybe into, selectively in the markets, but arbitrage funds have moved out from there and come in here. And that explains why P-note holding is at its lowest, and which also explains why markets at the end of the day have mapped the international trend, because local guys have picked up the baton.
So what are the sweet spots in this market when benchmark indices are at an all-time high?
So having, in a sense, gone against the grain by saying that the consensus doesn't hold, I think markets are smelling turnarounds in a few places. I think PSU Banks #1 spot, and as has been proved, this run may not continue because worries continue. So the PSU Banks and the core sector, these are the two spaces I think are climbing a wall of worry. So the wall of worry is, will NPAs get over? Will the discounts be much steeper? Let's take just the NCLT process. The first 180-day window is now coming to an end, and come December, January, expressions of interest will get converted by the resolution professional into actual firm changes of management, where the restructuring gives way to a new person coming in, where an existing person was declared a defaulter and therefore a new management had to be brought in. I suspect, because steel companies are at the heart of this restructuring, the steel space is extremely strong internationally, and therefore I think the bids will be much higher than the discounts originally feared. Banks have been providing quite aggressively. So if one or two cases, especially bellwether cases, result in changes of management at much smaller haircuts than anticipated, you can imagine which are the sectors. Not only will the sector benefit because the capacity is now gone into stronger hands, but more importantly, the bank that has taken the haircut will start actually writing back. Now, the two big changes in the bank accounting. One is, let us say, that total steel, this thing say 2 lakh crores of provisions have been made. And if they can for a moment find a 2 lakh resolution at, let us say, 1.25 crores, 1.25 lakh crores. So at one stroke, not only does the 1.25 lakh crores start earning, because this is now going to start earning interest or get paid down as an OTS, but more importantly, where 2 lakh crores was not being accrued, suddenly 1.25 lakh crores has started getting accrued and the liquidity returns to the asset under question. So I think this is like a double, not whammy, but a two-way benefit to the PSU Bank, and therefore the NIM increase could be much more than just 1.25 lakh crores suggests. It's actually, so this is, I think, a number not easily factored in by the markets. And as some of these resolutions happen, I think the PSU banks will move up much sharper than we anticipate.
So the rally in PSU banks, which happened because of recapitalization, do you think that is real?
Well, not because of recapitalization, actually because of the expectation of recapitalization.
Of course. Right. I mean, markets always look forward. Correct. Let me put it this way.
Right.
You think A, the rally is real, and B, better days are coming. But do you think all PSU banks will go up, or the strength will only lie with 2-3 top names?
I think the 2-3 top names, because they have already indicated that good performing banks that are recognizing and moving on, or the strong banks, will be the ones by definition who recognize the problem, and those are the ones who are going to get capital. So you're going to sort of give capital to an SBI when it may not need capital, but the need for capital, to my mind, is actually in SBI a lot lower than what people believe. So the SBIs, the BOBs, the PNBs will get capital when they may actually not require that kind of capital. But the need for recapitalization may not be that high. The good question is what happens to the weaker banks? Will they be in some sense sandbagged and put into the stronger banks? I hope not. I mean, I hope at some stage, there is a way to actually shrink the incremental exposure of these weak banks and in some sense quarantine them, because the reality is you can't weaken the strong guys by just putting in the weak guys in who have 17 and 18% NPAs, if you will.
So for an investor, let me start and tell me when to stop. I'll start with SBI, the go-to choice for investors.
Well, I don't want to talk stocks actually, but it's very clear. I mentioned these names as being the bellwether in the PSU, and they need to be backed clearly. I think any portfolio that today focuses on value, focuses on buying stuff at or close to book value in a space which is dominated by private sector banks at 3-4 times book or 2.5-3 times book, clearly you need to focus on the top 3-4. There's no question. I mean, you as a contrarian, more than a contrarian, now there is evidence of things happening.
Okay, what about the cozy trades? Close your eyes and buy private banks. Close your eyes and bet on a Eicher Motor or buy a Bosch. Do you think those cozy trades now will see cracks?
Well, if you really look at it, what has not changed is the recapitalization addresses the ability to lend. Does it address the mentality to lend? I don't know. So the issue is that there is a mindset which is still all pervasive, that today we've escaped a bullet because the officers kind of resolved issues, but now the next lending, if it creates the next Kingfisher or whatever, will 4 other people be slammed into the cooler, is a fear that is still all pervading. And I respect that, because when I talk to senior bankers, their question is there a way to sort of differentiate between an honest error in decision making and a downright corrupt decision? So how do you differentiate between these two? So as long as that fear remains, one good thing is that you won't have a repeat of the KFAs, hopefully. But more importantly, if the mentality to lend has not changed, the mindset still remains closeted, saying we've taken care of our issues, now sit back and wait for your pension check, then the growth doesn't come in, which is where the private sector banks continue and have not corrected, as people feared that the NBFCs who have taken up the slack in the MSME, in the corporate space, the private sector banks took up the slack in the large corporate space. The issue really here is that as long as the mentality doesn't change, the growth still comes there.
Now, Jakes, for most portfolio investors, NBFC stroke financials, they are heart of their portfolio. At least 35 to 40% currently is invested in private banks and NBFCs.
Are you sure of that?
Broadly, if I look at the portfolio allocation, it could be 30, it could be 35, because the benchmark is 35 now, broadly put.
That's as far as mutual funds are concerned, not individual portfolios.
Yeah, I'm talking about mutual funds now.
Right.
Now, mutual funds may suddenly see a huge opportunity which is coming in corporate banks. It could be PSU banks or it could be private corporate banks. what do you think they're likely to trim? Because you cannot take your exposure to financials to 50% or 60%. You'll have to sell some, you have to reduce your exposure to existing financials in order to make way for corporate banks.
So I think the point that's rightly said is, where does this new money come in? I think the first flush of wave that you saw was clearly short covering by a lot of institutions who had borrowed stock and sold because they couldn't go short on single stock futures. That short covering rally is over. Now these have settled at levels which are much higher than what they were. So for argument's sake, without talking specifics really, but if you were to take a specific one like State Bank, it went down to 240, after the rally went to 350, but has settled at 310, 320, let's say. So these are much higher bases, which indicates that people are now seeing the change, people are now seeing the trend change, if you will. In the allocation that most people will have, I think there is no way they will have to sell private sector banks to get into this. Exactly. So in a sense, the differential between these two on valuation parameters will narrow.
It will narrow.
It will narrow.
Okay.
Because I do believe that some of the strong PSU banks do have the lending culture that can bring growth back to it, along with just resolution of problems. I think the smaller banks may still be a victim of the old mindset, and therefore, but I watch this space because at the end of the day, unless this credit enhancement is clearly there, money is available, people need to lend, so they should be able and willing. That's the important thing.
Jake, what I've always admired about you is that your ability to think differently. You always like to go against the crowd, and the aim there is to get it right. So in this kind of a market where we've got a lot of cheery consensus in financials, FMCG, some odd metal stocks also, how are you investing differently? How are you proposing one should invest, the Jake said?
Well, I'll tell you, last time we talked about how the index investing is not going to hurt people. I think index investing for a lot of people at this stage has been beneficial. Now you could say you may not have got a three bagger, but you've got a pretty healthy growth, and portfolios are not made of three baggers alone. But if you want to get that, I think what you need to look at maybe some consumer facing names, dominant players who have not got their act and are turning. So for instance, you take high growth spaces. So high growth space, for instance, today is the aviation space.
Okay.
So there is wide disparity in valuation parameters. As a space, I'm saying every industry represents or in a sense depicts that kind of thing. So I'll give you an example of something that's happened. A USL in a good high growth space 3 years ago, United Spirits. Suddenly some triggers, liquidity needs, whatever changed, and you had the biggest 6-bagger, 7-bagger. Can this happen in other spaces? And I think that is where the contrarianism comes in. So for instance, metal space, metal space where large metal players are there. Some of them very richly valued, others are going through churn. Maybe there is a need to look at the infrastructure space, high debt spaces where people are retiring debt. I think there is an opportunity virtually in every industry where once dominant player is languishing and maybe ready for a change. I'm not saying every industry will happen. Or for instance, the PSU space. There is a big feeling that this PSU, whether with partial divestment or full divestment, is going to be a complete, repository of value. So, can some of the big infrastructure players in spaces like steel, in PSUs perform? So I'm saying every space will have one or two, and I kind of resisting the temptation while giving sort of hints as to what all spaces one could look at or where I am personally looking at. So all these spaces I think have extreme. I mean, the aviation, for instance, grows at 25%. The industry is growing. Have all players performed equally? The answer is clearly no.
So in aviation, would you bet at the number 2 player or the number 3 player?
I don't want to get into this again, but I'm saying this is one way of looking at spaces that have growth, where clearly dominant players who have not performed, you need to figure out if there is some change there. And I think that is one way to, you can't take a space which is growing at 1% and say, let's take a player, will he change? So I'm kind of pointing to the fact that look at the tailwinds in the industry where specific players may have their specific issues. If those issues start getting corrected, the gains can be huge. I gave United Spirits as an example to show how the space was growing, but not everybody was performing. So the same industry, you had United Breweries who was quoting at a 45 PE and a United Spirits who was languishing, and how that changes just because some triggers come in. And I think that is, to my mind, the alternative way of looking at things, that you need That's why I said infrastructure, that's why I said NCLT. Moment somebody says go into NCLT, they say no, we don't want to talk NCLT. But then you look at, companies in the NCLT, if there's a restructuring on, it's actually the greatest driver of equity value.
I want to also draw your attention to what's going on in the insurance space. 2 years ago, there was only one pure play insurance play in India. That was Max Financials. Now we've got
Virtually,
a dozen insurance companies. Some of them have gone public. Some of them are planning to go public. What is the best way to understand the insurance space?
I think you need to give 3-4 quarters of space to these guys to announce results, talk about things. Because I'll tell you, right now, almost any company coming through is being compared with an existing listed one, which is already pretty expensively valued. And therefore, the catch up in terms of making everyone as expensive or otherwise is coming through. The reality is the insurance space is still so much in its infancy here. So in that virgin valuation space, you will sort of tend to benchmark with say one guy who's quoting at extremely rich valuations and everybody tries to catch up. I think the focus here is allow 2-3 quarters to go, because this is going to be a space, here to stay, and it's going to be a high growth space with few dominant players. So if you don't know how to actually choose, take a basket of 3-4 players. But really speaking, I think a lot of the valuations are stretched, and it's not easy for individuals to make that decision. So maybe going through a mutual fund is probably the best way to play this.
But just to crudely divide the space into, let's say, 2 or 3 large pockets, life, general and reinsurance, which way would you lean?
I think all of them are in their infancy. I think all of them actually have huge, if you take life insurance, it's actually linked to to the home finance space, for instance, that every time somebody takes a home finance thing, I think the insurance policy follows more from a hedge perspective. So it's not easy to say that one space will grow faster than the other, but I think life clearly is a big space that's linked to consumption in some sense. It's linked to pickup of assets like the house, which every Indian wants to do. So I think it's not easy for people to take this, and I keep saying this because valuations will remain rich, growth will continue to be there. So you need to go back and say, this is the way people saw the Colgates and the Hindustan Levers in the 80s or 90s, that they invested knowing it was expensive, they remained expensive, they never became cheaper, and they continue to grow.
So can I say, if I have to draw a parallel, can I say buying insurance in 2017 or a basket of insurance companies in 2017 is like buying private banks in 2001 or 2002?
Maybe even earlier. Maybe even earlier.
But the market caps are already lofty, Jake. So I mean, something like LIC houses.
But they are lofty because today people accept a 20,000 crore valuation as also having achieved something. So they are lofty also because they are in a sense saying these companies will not disappear. A lot of private banks, people who invested in Global Trust Bank, for instance, lost everything. Yeah. Bank of Rajasthan lost everything, or at least that got merged with Global Trust Bank. Today, these insurance players are here to stay. So you could, there's no way to determine whether one will grow faster than the other. So a portfolio approach may actually work, or 3-4 quarters of track record in terms of earnings, governance, etc., indicates to you which could lead the way. And then there's consolidation that's already attempted to be happened but didn't happen in the case of HDFC and Max or whatever this thing was. So it actually indicates to you that even at this early stage people are talking consolidation. So I would be very reluctant to say, even as an individual who's in this space, who understands this space, be able to make a call as to one vis-a-vis the other today. And therefore, if I were to do it, the listed peers are few, but I think a portfolio approach here probably is better.
Jix, let's go back to our original thought. We started the show with your view on what could be called as a consensus view, and the consensus view is that liquidity is taking everything higher and markets are a one-trick pony. But at some point in time, valuations will haunt us. So if you really have to judge this market based on historical averages and where we are in terms of valuation positioning, how far are we away from a bust or a bubble? Because Jake's markets will follow a cycle. There would be a bear market followed with a bull market, and there would be a bust or a bubble. So where do you think we are in the cycle?
Let me give you an example of why this thinking doesn't always, are you asking me, will markets correct? I think the answer is obviously they will. But will corrections be the 15-20% accommodative correction that allows everybody to walk in and participate? I think the answer is no. And the reason it's no is that people have now tasted blood.
Okay.
The SIP investors have tasted blood. That they don't need to, put their house on a hunch and take an all or nothing call. They can invest every month and still feel wealthy at the end of a 2-year process. And that wealth effect results in all kinds of other consumption patterns changing, etc. I think the call would be something like a telecom sector, for instance. Okay. Not one person said that this is not a race to the bottom. That everybody was pricing themselves in a manner that the race to the bottom is inevitable. And yet you've had the biggest rise in these telecom stocks. Why? Because one player decided now enough is enough, I'm going to start increasing the prices. The moment you increase prices, the mentality changes. Now, without a cartel being formed, it's live and let live. And suddenly profitability can return. So, I think it's difficult to say that so did those stocks go down to bankruptcy valuations? I don't think they did, because they sensed that at some point this will stop, because the industry was consolidated. So, I think the important thing here is to figure out, if industries are consolidated, these may be short-term pressure points. Cement has seen this time and time again. Every time pricing pressure was there, miraculously it corrected. But the consolidated players are now making reasonable amounts of money and growing. Stocks are at, multi-year highs, and you move on. So, I think valuations are already catching up. I mean, it's wrong to say that we are an overvalued market, because capacity utilizations across the board are at 70-72%. So, there's headroom for capacity to grow. New capacities aren't coming up. So, pricing power by definition is there with existing guys. As demand picks up in whatever manner, the existing capacities are going to get taken up. So, why do you say that this market is overvalued on valuation? I don't agree at all. I think valuations are catching up, and some of the spaces like metals are looking actually pretty, if you will, they are under-owned.
If you have to divide the market, let's say, into 2 or 3 pockets. Pocket number 1, sectors which are due for consolidation. Pocket number 2, sectors which are due for correction, and sectors and themes which are about to come out of that long consolidation phase. How would you map the market in these 3 pockets?
I mean, I would say that in general markets are, clearly not cheap.
Okay.
But can you therefore say as a corollary that markets must roll over, play dead, and have a correction of 20%? I don't think the two follow. I think markets are not cheap, but they can remain expensive for long periods of time. 2, participation for the first time is followed with gratification, which means that people in the SIPs also feel, if I put 5,000 or 10,000 a month and I feel wealthy at the end of it, there's nothing wrong in continuing to do this. So, who are we to determine that markets therefore are overvalued? I'm saying, I am debunking the theory that just because markets tomorrow correct to a 9,500 doesn't mean that the markets they may have been overvalued at a point in time, but I think the corrections I'm seeing are 3 and 4% at all points. It's not like a 20% correction where everybody gets a chance to participate and therefore satiate himself. That is not happening.
So, stay on course.
I think stay on course, stay invested. The markets will make new highs, and to my mind, there will be a grinding market.
Okay.
4-5% correction doesn't make this, the end of the world, but a 20% correction with no conceivable thought. I mean, you've had North Korea going gangbusters, you've had problems in the US, you've had problems in different parts of the world, and markets have borne those out. So, I tend to believe that you need to have something dramatically wrong, and individual pockets, by the way, when the pharma problem, let me just stay focused on that. When pharma companies had a problem, stocks got decimated. A Dr. Reddy came down from 4,500 to 1,900. Divi's came down from 1,100 to 600.
Yeah.
So, is that not a correction? So, markets in a bull market punish a good sector with good companies as ruthlessly, and in fact, as they say, markets sell more passionately than they buy.
Of course, that's a great way.
Yeah.
But if I have to summarize our today's interaction, you would say, like, look, let's not do rear view driving. That will not make money. Markets always pay for tomorrow's growth, and the future is looking bright. And as of now, according to your analysis, there are no data points which are indicating that we've entered or we're about to enter a bubble zone.
I think as a market as a whole, that is right. Individual pockets will always be there.
Of course.
I don't want to get into that and there are enough pockets which will give you seriously good returns. I think that's the underlying theme in stock picking.
Jakes, appreciate your time. Thank you for joining us.
Thank you.
That's it on this edition of Market Makers. Thank you for joining us, and thank you for tuning in.